Hey guys, this is Mrs. Schoenberg. I am here with the Chapter 12 notes. I think I'm going to do this lecture in two parts. At the end, kind of about three-quarters of the way through, I'll stop and according to the notes, there's some problems that we'll go over on part 2 of the video. So we're at Chapter 12. We're getting close. This is all about corporation, how they're organized, how they process stock transactions and dividends. So let's jump into it. There's some terms you need to be aware of. A corporation is a legal entity distinct and separate from the individuals who create and operate it. A corporation can sell shares of stock called, wait for it, stock. Corporations whose shares of stocks are traded in public markets are called, wait for it, public corporations. Corporations whose shares are not traded publicly are usually owned by a small group of investors and are called non-public or private. So, some sources of stockholders' equity. We've been doing stockholders' equity all year long, but here is what monies, if you will, flow through stockholders' equity. You have your paid-in capital, which is basically a fancy term for issuance of stock, and you have your retained earnings. Some characteristics of stock. The number of shares of stock that a corporation is authorized to issue is stated in its charter. So when a corporation starts up, it makes this charter, and some of these things need to be known ahead of time because they're published in the charter. The stock remaining in the hands of stockholders is then called outstanding stock. So outstanding stock is stock that's owned by the stockholders. Shares of stock are often assigned a dollar amount, and this is called the par value. Types of stock. When only one class of stock is issued, it is called common stock. Okay, that's what we've dealt with so far, common stock. Each share of common stock has equal rights. When a corporation issues more classes of stock with various preference right, one or more, but they have variable rights, these stocks, such as preference to dividends, these stocks are called preferred stock. So there could be your common stock and they could be your preferred stock. Generally, preferred stock holders have the first rights to any dividends, so they have a greater chance of receiving dividends than the common stock holders. Treasury stock is the third type of stock here that we're going to talk about. It is stock that a corporation has issued and then buys back. Here we'll put reacquires, or they've reacquired the stock. No dividends are paid on the shares of treasury stock. Okay, issuing stock. Assume that a corporation is authorized to issue 10,000 shares of 100 preferred stock, and they can issue up to 100,000 shares of $20 common stock. Okay. The corporation issued 5,000 shares of the preferred and 50,000 shares of the common. And here is the journal entry. Now notice when a company offers stock, the stockholders are buying it. So this is going to be an influx of cash. This is going to be a debit to cash. Okay, so we know it's going to be a big old debit to cash, and let's figure out that. We had the 5,000 shares of the preferred stock, and that was times 100. That's the preferred stock price. So that's 500,000. And then we also had the 50,000 shares at the $20 price. So money coming in from that's 1 million. Adding these two numbers together, you'll get this cash of 1,500,000. You're going to credit preferred stock for the amount of 500,000, and you're going to credit common stock in the amount of 1 million. All right, that's the basic, simple, makes sense, right? Well, sometimes stocks is often issued at a price other than its par. The previous example was par. The price at which stock is sold, again, depends on a variety of factors, such as the following. And I don't list anything here, but you can imagine, what's going on in the market. What's going on in the particular business industry. All types of factors like that. So we are going to jump into some problems, and the nice thing about this lecture is I'm doing problems that are exactly like your homework. The numbers have been changed just a little bit, so you can follow along here, do the practice problems with me, and then when you go to the homework, refer back to it. This is an above par stock example. On January 22nd, Butler County Rocks, a granite contractor, issued for cash 110,000 shares of $40 par common stock, but they got a selling price of $44. And then on February 27, it issued 15,000 shares of preferred stock, $8 par, but they got a selling price of $11. Okay, so here's what that entry looks like. We're going to do both entries. Let's do January 22nd first. January 22nd, they got a whole bunch of cash in. And here's the number I want you to write down. 4,840,000. And then to the side here, let me show you that calculation. I took the 110,000 shares times the selling price of 44. Okay, that's how we got that calculation. We're going to credit, this was our common stock. So when we credit the common stock account, the number we're going to use here, credit 4,400,000. And the calculation on that is you're going to take the 110,000 shares, but this time you take it times the par value. There's one more account that we need to use. It's called paid in capital. It's a really long account name. Paid in capital, excess of par, common stock. Good grief. It's such a long account number. It's basically like, what was the extra that people paid above and beyond? Well, the calculation is 440,000. That's the number. And the calculation is the same 110,000 shares times the extra, right? Because if you think about it, they paid $4 more. So if you take 110 times 4, 110,000 times 4, okay? And that was for the common. So now let's do the other entry, which was the February 27th. How much cash did they get from the sale of this preferred stock? The number is 165,000. And the calculation on that is the 15,000 shares, and you take this times the $11. And that's how you get 165. And then there's two accounts as well. We're going to credit preferred stock. And then we're also going to credit paid in capital, excess par, and then preferred stock. Okay. Anyway, the preferred stock amount is going to be 120,000. That's a credit. And that calculation is the 15,000 times the $8 par. And then the credit for the excess, you could either subtract these two or take the 15,000 times $3. But that amount is 45,000. That's also a credit. Sorry, my credits do not line up here. So however you want to take it, you could subtract your debit from your credit, or you can see that the difference between the selling price and the par value is $3. Okay, 12.4, entries for issuing no par stock. On May 15th, Big Red Carpet, a carpet wholesaler, issued 550 shares of no par common stock with a stated value of $1.50 at $3. And on June 30th, it issued 17,000 shares of preferred stock, $40 par at $50. Journalize the entries for May 15th and June 30th, assuming that the common stock is to be credited with the stated value. Okay, this is just a really different way of saying it's like no par stock, but instead of saying a par value, they said the stated value. It's really done the same way as the last problem. So let's get this going. May 15th is the day they did the common stock. The cash received on that day, it's a debit, 1,650,000. The calculation is 550 shares times $3. Then that day they're going to credit common stock for 825,000. The calculation is 550,000 times $1.50. And then we're going to have paid in capital, excess common stock, and that amount is the difference of the two, 825,000. Okay, that was the May 15th entry. Now let's do the June 30th. June 30th, cash received. The amount is going to be 850,000. The calculation on that is 17,000 shares of stock times the selling price at 50. You're going to credit your preferred stock. That amount is going to be 680,000. That is your 17,000 shares times your par value of 40. And then you can either do the difference of this, but it goes into that paid in capital preferred stock account. Okay, and the amount is 170,000. And that's how you're going to do 12.4 on your homework. 12.5. This is interesting. This time they're going to issue stock for assets other than cash. Okay. So on November 23rd, Tall Lift Corporation, a wholesaler of hydraulic lifts, acquired land in exchange for 13,200 shares of 22 par common stock with a current market price of 33. All right. I bet you guys are getting good at these. Here's what this is going to look like. November 23rd, instead of cash, which is what we normally debit, what are they getting? They're getting a big old piece of land. Here's how we're gonna, let's hold off on this debit amount, okay? Let's calculate what this land's gonna be valued at. Okay, well, the credit is gonna go to common stock and also paid in capital, excess common stock. Okay, so let's do some calculations. If we take 13,200 shares times the par value of 22, we're going to get this number, 290,000, 400. And then if you take the 13,200 times the excess, okay, $11. The current market price was $11 more. So that excess goes in paid in capital, and that amount is 145,200. Well, if I take these two numbers, add them together, I'll get the value of the land. And this happens to be 435,600. Okay, so that's how you'll do 12.5. Now, entries for cash dividends. I like these. I feel like they're kind of easy. But there are some terms you need to know. There's something called the declaration of a dividend, the record or the recording of the dividend, and the payment of the dividend, okay? And each of them can have separate dates, okay? We have a July 8th for the declaration, August 31st for the recording, and October 1st. Okay, so you need to know that there is no entry on the date of record. which is going to be the August 31st. No entry. So we really only care about journal entries when we declare it and when we pay it. And here is the July 8th date of declaration. The company comes out, they issue a statement, and they say, hey, we're going to pay a cash dividend, and we'll make that payment on such and such date. So on July 8th, when they declare it, you actually have to debit this account called cash dividend. Sometimes you'll just see dividend. Sometimes it'll say cash dividend. You can do dividends other than cash. So saying cash dividend is very specific. But anyway, we're just going to use this number they gave us. When you declare the dividend, you haven't paid it yet, right? So then you go to this account called cash dividend payable, a liability account. So they're setting aside the money to pay that out. And again, you might see this just as dividend payable. Then October 1st comes around, that's the actual payment date. So they're going to debit cash dividend payable to clear that amount out. 1575000, and they're actually going to credit cash. Okay, not too bad. Those are not too bad. Okay, 1211 it deals with stock splits. And let's just see where we're at here. We're going to finish this page. Yes, we're going to finish this page, and then I will take a break, and we'll come back and do the next. Okay, so effects on stock split. Bojangles Grill and Restaurant wholesales ovens and ranges throughout the Midwest. Bojangles Grill and Restaurant had 225 shares of common stock outstanding. That means, remember, that's the stock that's out there that the stockholders own. And then they declared this 3-for-1 stock split. So the question is, how many number of shares will be outstanding after the split? Well, 3-for-1 means if you had one, you're going to triple it. So you're going to take your 225,000 shares times 3. And so now 675,000 shares are outstanding. If the common stock had a price of $3.60 before the share split, what would be the price after? So in this one we just did before, we multiplied. But now it's worth a third. So this one we divide. So if it was $3.60, then you divide by 3, and now it's $1.20. So apply that concept to homework 1211. Okay, now we're talking about treasury stock. And if you recall, treasury stock, it's a weird name, right? But what it means, it sounds like it's government or something, but what it means is the corporation had issued stock and then they bought it back. Okay, the following transactions were completed by Grayson Inc. during the first fiscal quarter. They reacquired 10,000 shares of its own $10 par common stock, but when they reacquired it, they paid $30 to get it back. So here's what that entry looks like. April 19th. Okay, again, the company is paying. They're not getting cash this time. They're repurchasing their own stock. When they bring it back, we're going to debit the treasury stock, and the amount is 300,000. Okay, the calculation here is 10,000 times 30. The credit goes to cash. They had to shell out $300,000 to buy back their own stock. All right, August 30th. Then after they, some time goes by and they're like, let's sell some of this. Let's go ahead and sell it at 36. Okay, let's go ahead and sell it at 36. So they did get cash and they sold some treasury stock. They got some cash. The debit amount is 216,000. The calculation on that was the 6,000 times the selling price. Okay. Then the credit goes to treasury stock, and the buyback amount, remember they bought it back for 30, so you're going to take it 6,000 times the 30 to get 180,000. And then you guessed it, the extra goes into paid in capital excess treasury stock. The difference between those two numbers, or you can actually do the calculation, it's going to be 36,000. Okay. And then finally, November 10th, they sold 2,000 at $25. And so this is going to be, this was less than this $30. $25 is less than the $30. So pay close attention on this one. November 10th. They sold some stock, so they're still going to get to debit their cash, and they are going to debit it for $50,000. And the calculation on that is the 2,000 they sold times the $25. That's the 50,000. Skip a line and do a credit to treasury stock. And put the amount here of 60,000. This number happens to be 2,000 times the $30. When they repurchased it in, it's sitting in their stock vault at $30. So that's what they have to take it out of. That's credit. So look at the difference here. We've got a $10,000 difference. And it does have to be a debit. And in this case, paid in capital is going to be a debit. So it's paid in capital, excess treasury stock. Gets the debit there. Okay. Then question B says, what is the current balance of paid in capital from the sale of treasury stock on December 31st? So if you look at this, paid in capital had a debit, which is a good thing, 36,000. From that August 30th. And then they sort of ate away at that on the November 10th. So the balance is 26,000. All right, last one, then we'll take a break. Homework 1220, retained earnings statement. Best Pumps Corporation, a manufacturer of industrial pumps, reports that the following results for the year ended December 31st are as follows. They've got their retained earnings, they have their net income, they have cash dividends, and they have stock dividends declared. So let's recall how to do a retained earnings statement. 3-line titles centered, Best Pumps. Second line is statement name, retained earnings statement. Let me get my, and for year ended 20Y3. That's fine. Okay, remember that retained earnings, we'll see how many lines we're going to have. We're going to have 5 lines. We start with the beginning balance. Retained earnings, beginning balance. If this was December, so it would have been January 1st, 20Y3. And that number is 59,800. Then we add to it any net income or subtract net loss. Okay, so net income is, I'm going to set up a new column right here, 8250. That's a plus. Then we're going to subtract the dividends. So actually adding these two numbers together, we have 3,600. And then this next line is change in retained earnings. And you'd think we'd put it here, but we're gonna 8250 minus 3,600. That number is 4,650. Draw a line. And then the very last line is retained earnings, December 31st, 20Y3. And that number is, this is an addition, okay? So you're going to add those two numbers together to get 64,450. All right, that's the end of this lecture, and we'll pick it up here in a little bit.